Hello, thank you for joining us today. My name is James Wynn and I'm the Director of Business Development at Attorney Credits. Though we are several months away from the official start of tax season, it is always smart to organize and prepare early. In today's webinar, we're going to discuss tax preparation strategies for attorneys, how to maximize your deductions while minimizing your chances of getting audited by the IRS. To discuss this topic in greater detail, please welcome Sam Brotman. Sam, welcome.
Thank you, James. Good morning, everybody. So in this presentation, we are going to talk about tax preparation strategies for attorneys. And since I'm not a CPA and I'm an attorney, I'm going to give you my perspective on this issue so that you have a really good sense going into tax season on what to do exactly. So a little bit about, sorry, let me just get to my slides. There we go. So standard disclaimer, this is meant as general tax advice. It is not, it's not for anybody to rely on specifically in this instance, although the general knowledge will help you in meeting with a CPA or meeting with a tax attorney such as myself to go over and strategize. But I want to give you kind of the broad overview of some of the things that you can do on your own returns and with your own law firms to help mitigate tax issues and to basically be as tax efficient as possible. So a little bit about me. I run my own law firm in San Diego, Brotman Law. We specialize in two things in plain English. Number one, we represent people in audits, so income tax audits, in addition to payroll tax audits and sales tax audits. And then we defend people who owe more to the government than they can pay. So my background and expertise is different from that of an accountant, and I want you to understand that from the outset. So CPAs are generally focused on reporting and compliance obligations. So if you go to a CPA, your CPA is the best person to help you figure out where the numbers go on the tax form. Your CPA is going to have a general knowledge of tax law. But your CPA is not going to know the procedural aspects of tax law. So for an example, if your CPA sits down and they go to a meeting with an auditor, they're going to be able to explain the tax law and the auditor is going to be able to agree or disagree, and they're going to have a conversation back and forth. When I sit down in front of an auditor, I'm also able to explain the tax law, but I know how the auditor is going to react to certain things. So I know how the auditor is going to look at substantiation. I know how the auditor is going to look at ordinary and necessary business expenses. I know the reaction of the auditor's manager. I know the reaction of the IRS Office of Appeals. And I know the reaction of district counsel if we have to go all the way to tax court on this issue. That is important from a tax preparation standpoint, because not only are we going to be looking at the numbers, we're going to be looking at what's really behind the numbers, and if these positions get challenged, how likely are you going to be to sustain those challenges? What makes a position reasonable and not reasonable? So this is not a course on how to do your taxes. This is a understanding how to maximize your tax deductions, understanding how the IRS looks at tax deductions, and really getting the most benefit out of that situation. So let's talk about choice of entity for a minute, because I get a lot of choice of entity questions. The main reason why people incorporate is either A, protection of liability, or B, tax purposes. From a liability standpoint, an attorney can't limit liability with respect to their own acts. So you can't set up a corporation, make the corporation solely responsible for your bad actions, if there are any. That's what malpractice insurance is for, to some limited degree. But an attorney can limit liability for their partners or for their employees. In addition, corporations make it difficult to attach personal assets if there's entity protection and if the entity is sufficiently capitalized. Risk, as I mentioned with respect to most attorneys, is mitigated through malpractice insurance. So from a liability standpoint, if you are a very, very small firm, or if you're a solo practitioner, there is not a real reason to incorporate, because most of your liability can be mitigated through insurance. Some exceptions, but for the most part, liability can be mitigated through malpractice insurance. I do want to say one thing before we get too much further. If you do have a question, please submit it into the question box, and we can do Q&A after we go through all the materials, and I'll try and answer as much questions in as much detail as possible in exchange for you guys sitting through this presentation and learning about these issues. Anyway, back to the topic at hand. So from a liability perspective, for attorneys, it may or may not make a whole lot of sense to form a corporation. However, from a tax perspective, it does make sense. So first of all, let's get to LLCs. In most states, California being one of them, you are prohibited from forming an LLC that is a legal corporation. So you can, when people say, I want to start an LLC, you can go ahead and throw that out the window with respect to a choice of entity for your particular law firm. Next, we go into sole proprietorships. So sole proprietorships are reported on your 1040 Form Schedule C. They alleviate you from the responsibility of having to file a separate tax return. They're very easy to set up. They're very easy to keep track of. But there is a downside to sole proprietorship. The first is that sole proprietorships are taxed on their net business income as if it were wages. So the downside with that is not only are you going to pay income tax on your earnings from self-employment, you're also going to pay something called self-employment tax. And self-employment tax is the contribution to Medicare and Social Security. It is equal to about 15%. So if you are a sole proprietorship and you happen to have your own tax returns in front of you, go ahead and flip to the second page on the tax return, the page that you sign. And when you go down to about the middle of the page, you're going to see total tax. And part of that is going to be self-employment tax. And as you can see, particularly if your revenues are over about $100,000, you are going to get hit with a fairly significant amount of self-employment tax. So sole proprietorships are good for smaller law offices. If you make under $100,000 a year and you are a sole proprietorship, then it might not make sense for you to form an entity for tax purposes. The reason for that is that there is a cost for forming an entity. So if you form a corporation, you now have to file a corporate tax return and pay a fee to the Secretary of State of whatever state you're in, and probably do a fictitious business name or a DBA, and probably fill out a statement of information or a comparable form with the Secretary of State, letting them know about any changes to your corporation. And you'll probably have to pay city business tax, which may be higher or maybe about the same for a sole proprietorship. It depends on the taxing locality. But the long and the short of it is this, is there is an inherent cost of forming a corporation. And if the amount of self-employment tax that you are paying is not above what the cost to form that corporation is, then you should go with the most cost-effective option, which, by the way, is also the most tax-efficient option in this case. So let me give you this straight benchmark test. In California, it's about $800. It's $800 a year with the Secretary of State for the privileges of doing business in the state of California. In Most CPAs that I know charge anywhere between $1,000 and $1,200 to do a corporate tax return. There are probably about, we'll call it $200 to $300 in miscellaneous filing fees. So we add that up, we got about $2,300. If the amount of self-employment tax that you are paying is under $2,300, my general recommendation is to not form a corporation. If the amount of self-employment tax you are paying is over $2,300, as in the case with most solo practitioners or law offices, it makes complete sense for you to form a corporation. So some of you are looking at your tax returns and you're seeing the amount of self-employment tax you paid and you go, I'm way over $2,300. And as a result of that, you are coming to the realization that you have probably just overpaid in tax. So stop doing that as soon as possible. Now we move on to corporations. We have S corporations, which are probably the most popular. And the reason S corporations are popular is because S corporations are considered pass-through entities with the Internal Revenue Service. So when you form a corporation, corporations are formed at the state level, and you don't get to elect C corporation or S corporation at the state level. You elect it at the federal level. So what an S corporation is you make an election to be taxed under subchapter S of the Internal Revenue Code. Subchapter S specifically does not have any tax at the corporate income level. Rather, all that tax will flow through to an individual through a K-1 on a personal level. A C corporation does have double taxation. There is a tax at the corporate level and a tax at the individual level. Generally, it's not a good idea for small business owners, including law offices, to be C corporations. There are some advantages to that, particularly when you have a partnership or some more complicated entity structure. So I'm not saying that C corporations are completely excluded from the law practice, but for probably 99% of the people watching or listening to this, an S corporation is going to be the best way to go. As I mentioned, there's no federal income tax on the S corporation's income on the corporate level. State tax rates are usually lower for S corporations versus other types of entities. So people will ask me for other businesses, not law firms, because LLCs are not good vehicles for law firms. But they'll ask me whether they should form an LLC or an S corporation. And most of the time my answer is form an S corporation, because California has something nasty called gross receipts tax on LLC, where the more money you make, the more tax you pay. S corporations don't get taxed on distributions to shareholders, and opportunities to reduce employment taxes in S corporations by balancing the compensation you receive for services versus the compensation you receive for profit. So, and we'll get into that in a little bit. Here are the drawbacks. So S corporation income is subject to the individual income tax rates of individual shareholders. So if you're in a 39% tax bracket, S corporations may not be as tax advantageous as you would think. S corporation income is also taxed directly to shareholders whether or not distributions are made. So there's no concept of retained earnings with an S corporation. Everything that's earned, whether or not it actually goes to the individual shareholder or not, will be taxed. So even if you have $5,000 at the end of the year sitting in your S corporation savings account, you are going to pay taxes as an individual on that $5,000, whether or not you get the benefit of that or not. So for some instances where it makes sense to have a lot of retained earnings, an S corporation is probably not the best vehicle, because you are going to be taxed at a fairly high rate on those retained earnings. So I want to talk to you a little bit about the 10,000-foot view of running a tax efficient practice. And the reason we're going to go over this is because I want you to think about your tax return as I think of a tax return. And the way I think about a tax return is a tax return is a reporting to the government on what your income is, what your revenue is, what your expenses are, what your profit or what your income is, and then also the amount of tax that you should be paid. So particularly for those of you who are running either single member S corporations or sole proprietorships, I want you to think about the enterprise of you. And the enterprise of you is you as an individual and you as a law firm owner / associate in that firm / whatever. So you have a personal enterprise if you are a sole practitioner. You have a personal enterprise if you're in a partnership as well. But for simplicity of illustration, let's just talk about sole practitioners. So your law firm depends on you as the sole practitioner to be the revenue generating function of that business. So your business relies on your services to generate revenue. Your services can relate to A, the legal work you do, B, the marketing and advertising and networking you do to promote your business, and then C, the management and administration of your business. So on a 10,000 foot level, your business generates revenue. You deduct business expenses from this revenue, and you are left over with a profit. And the government is going to tax you one way or another on the amount of profit that you generate. So probably the burning question for most of you is, well, how do we minimize our taxes? And the answer to that is you can minimize net profit by maximizing the expenditure in your business. So again, it doesn't make sense from a business standpoint to cut revenue. You don't want to say, well, I don't want to pay money in tax, so I'm just going to make $500,000 this year instead of $1 million this year. There's no benefit to doing that. So really what our tax system rewards is it rewards businesses that invest profits back into the firm. So if I am running for the month of October and I do $50,000 in legal revenue and I have $45,000 in expenses and I have a $5,000 profit, I have a choice. I can keep this $5,000 profit for myself, or I can invest my $5,000 profit back into my own law firm and pay taxes on it, and not pay taxes on it. So obviously there is going to be some sort of payment to the owner so that you can pay for your personal living expenses and your other ordinary and necessary living expenses. But law firms operate generally at about a 50% margin. It depends on the law firm, and as law firms get bigger, they may not operate at a full 50%. So for larger law firms that have staff costs and have more substantial overhead, you might be looking at like a 40% margin or a 45 or a 35% margin. So somewhere between 35% and 50% is the profitability that you can expect from your firm. Okay, you're going to have between 35 and 50% in profits for most law firms. And if you have numbers, if you are using QuickBooks, which I would highly recommend, or some sort of accounting software, you're going to be able to see that your expenditure should be about 50% of what your revenue is. So the inverse of this, from a business planning standpoint, is if you want to be call it $1 million law firm owner, you're going to have to spend $500,000 in your law firm. That just is what it is. So the benefit to doing this is that by taking your profits and investing them back in the law firm, assuming those profits are invested responsibly and not just wasted, you're going to be able to grow a law firm a lot faster based on this. And from a tax standpoint, the more of your net profits that are being invested back in the firm, the less amount of tax that you're going to pay, because the lower your net profit is going to be when you report your taxes at the end of the year. So the other thing we're going to cover is what I call personal satisfaction expenses. So if we look at the Internal Revenue Code and define what an ordinary and necessary business expense is, IRC 162 is the controlling code provision. And if you have access to legal research and want to go ahead and try and do some research on IRC 162, you're going to see a litany of cases. But breaking this down very simplistically, we have ordinary and necessary expenses. So expenses that are deductible for business purposes are those that are ordinary and necessary within the course of a business. They have to be part of that trade or business, obviously, and they have to be paid in the tax year that they were incurred. So the common question I get is, what about credit cards? Well, credit cards, that expense is incurring in the year in question. So if I buy $5,000 in office equipment and I put that on a credit card, I can take that $5,000 deduction in the year I earned it. However, the payments for the credit card is not a deductible expense. So I can't charge something to my American Express card and then pay Amex later and take the deduction twice. That doesn't make any sense. But personal satisfaction expenses are a very gray area in terms of most people's personal enterprise. So just because the IRS writes the rules on what expenses are deductible doesn't mean they get to tell you how to allocate your expenditure. So your business earns a certain amount of profit, or your business generates revenue based on your efforts. The IRS doesn't get to tell you what networking events are appropriate and which ones are not. They don't get to tell you what type of auto expense you should be deducting. They can give you guidelines based on what's ordinary and necessary, but if you want to purchase a truck for your law firm, they are not in the position to tell you don't drive a truck versus, drive a Honda or something like that. So personal satisfaction expenses are things that I describe as something with a specific business purpose, but that have a certain personal component to it. So an automobile expense is a great example. Automobile expenses, you are allowed to write off vehicle expenses as an ordinary and necessary business expense. You're supposed to allocate the business use component to the personal use component. So let's say that you use your vehicle 75% of the time for business and 25% of the time for personal. Then you can take a 75% deduction on the total cost of that automobile. What automobile it is not really the business of the Internal Revenue Service. You get to decide whether you want to drive a Honda Civic or whether you want to drive a Mercedes. You are ultimately the business owner. You are making a reasonable decision on how much to allocate your expenditure. So just because you get to write off the money you putting into a Mercedes doesn't alleviate you from the burden of paying $1,000 a month for that Mercedes, but you have a high degree of flexibility over the choices that you make in your own business. And when I sit down on an audit, one of the great advantages I have over the auditor is that auditors don't understand how businesses are run. And they're not really in a position to question the business judgment of the owner of that business, so long as it falls in to the ordinary and necessary expense categories. So educational travel for work with a personal component, great things. There are CLE programs in places like Hawaii and places like, wherever you like to go on vacation. CLE companies have gotten on board with this and said, well, if we're going to be learning about the taxation of partnership income and how that relates to A and B mergers, we might as well do that sitting on a beach in Maui versus sitting in an office in the middle of nowhere. So just because there's educational travel involved, and just because that educational travel has a personal component, doesn't necessarily negate the ordinary and necessary characterization of that travel. If you push it and the travel appeals to be more personal than business related, then you might step on the line of ordinary and necessary. But inherently, if there is some personal benefit out of the business expenses that you are getting, it doesn't necessarily mean that that expense is non-deductible. There's something that we refer to as de minimis fringe benefit. And de minimis fringe benefit is an equally litigated term along with ordinary and necessary expenses. And from a de minimis fringe benefit standpoint, it is okay to get a little bit of enjoyment out of your business. You wouldn't be practicing law if you didn't enjoy it. And so when you go to networking events or when you go to the state bar conference, they just had a big state bar conference for tax attorneys out in Carlsbad. They did this beautiful resort. They had all sorts of food and they had a hosted bar by one of the legal vendors. I enjoyed going to that. So I enjoyed it from an educational standpoint. I learned all about the new California Office of Tax Appeals, which is there's not really much to learn about the new Office of Tax Appeals, but I also learned a lot of things that I'm going to be able to take and transport in my practice, but I also received a personal component and a big degree of personal satisfaction out of that. There is nothing wrong with doing that. The point of this conversation is that when you look at your business from a financial management standpoint, meaning what are we going to be able to do? Think about that aspect of it. Is you are entitled to structure your life, especially your business life, and create a working environment for yourself that is enjoyable, and you can maximize the tax capacity based on that. So, educational travel for work with a personal component. I already mentioned CLE travel. Seminars or learning activity. There are a great number of seminars all across the United States in a lot of places. I've always wanted to go to New Orleans. There is a sales and use tax conference, conveniently in New Orleans next year. I will be attending that. I will be writing off the educational travel, and I will be writing off the meals and entertainment deduction associated with the great food they have in New Orleans. All that is entirely permissible under the Internal Revenue Code. Personal growth workshops, leadership conferences for business owners. There are lots of things that you can use as educational travel that will contain some sort of personal component. Aside from the satisfaction you're getting out of the educational experience, and you can still write these off. So, I know attorneys that don't really take vacation time. They just kind of plan their CLEs around, things that they want to do. So they'll go for a CLE workshop and extend that out into a weekend, separating the business aspects from the personal aspects. But the plane ticket is tax deductible. The portion of the hotel rooms that you were there for business is tax deductible. And, there's a substantial benefit for that. And that helps kind of subsidize some of the personal things that you may like to do outside of your job. Automobile expense. So I get asked this topic a lot. What is a reasonable automobile expense deduction? The answer is there isn't really a guideline for that. There is a guideline, especially on the audit level, for determining business versus personal use. That is super, super important. However, there is nothing that says you can't go out and lease a Mercedes through your business. There's nothing really that says you can't go out and lease a Ferrari through your business if you really want to. And I have had cases with very prominent business owners who have very, very expensive toys that are leased through the business. And we've been able to escape challenges from the IRS on that. You know, arguably, if you're driving around in a fancy car and promoting the image of success, there is some tangential benefit to the business on that. So while it may raise a red flag, at least initially, there's nothing wrong with writing off your Ferrari through the business. Again, it doesn't necessarily mean that you are not alleviated from the expense of paying for that Ferrari, but you can basically maximize your automobile expenses as you see fit. What is not reasonable? Personal use, as we described, commuting mileage back and forth to your office. So any trips to and from the office are not reasonable. The way that generally works from a preparation standpoint is most business owners will expense the actual deductions versus taking a mileage allocation. And so, you know, those are things that are very, very important. Meals and entertainment expense. So working meals. My law firm has a policy equally for all of our employees that if you work past 7 o'clock at night, the firm will pick up a meal up to $25. So that is a working meal. You cannot have a working meal policy that discriminates against employees. You can have a working meal policy that disproportionately favors the owner. So although I would like to say my staff works past 7, I don't mandate that they work past 7, and most of them get out of the office every day by 5:30 or 6. So they don't necessarily qualify for the working meals. If they want to stay in the office and produce more billable hours, they are more than welcome to take that working meals deduction. Meals and entertainment. So meals and entertainment expenses are generally allocated 50% for as a deductible expense and 50% as a non-deductible expense. There are some limited exceptions to that. But with meals and entertainment, the same thing goes, is the government is not really in a position to tell you which meals and entertainment deductions are reasonable and not reasonable as long as you fall within the guidelines for that. So if you take a close friend who also happens to be a prospective client out for a meal and you pick up the tab and you expense that, so long as you can substantiate who you had the meal with, so long as you can substantiate that there was a business discussion during the course of the meal by writing on the receipt what you talked about. So when I go out to lunch or dinner with anybody, at the end of the meal, I'll pick up the receipt, I'll write who I had the meal with, and I'll write a very brief description of what we talked about that doesn't break confidentiality restrictions. And if I were to present that to an auditor, the auditor would be totally fine with it. The auditor is not in a position to go back and question how much of the meal was devoted to business or personal. As long as some business topic was discussed, that meal is deductible. So again, how much is allowed as a business expense? It's generally 50% and 50% deductible, 50% non-deductible. The next part of this we're going to talk about is reasonable compensation for attorneys. And reasonable comp it's a hot topic within the IRS. It is also a hot topic within a lot of CPA firms in terms of how to do a proper allocation between attorneys as owners and between attorneys as the associates in their own law firm. So reasonable compensation is the idea that attorneys need to be paid properly for their services, and that wages that are earned associated with services are subject to either A, self-employment tax, or B, they are subject to Social Security and Medicare tax. So if you pay yourself as a W-2 employee then you automatically deduct meals and entertainment. You will automatically deduct Medicare and Social Security tax out of that. So that is something that you need to be aware of. On the flip side, if you receive a K-1 from your S corporation, and that is attributable to the profit in your law firm, you are not going to be taxed on that profit. So you perform work as an associate, you have a cost of services, what you cost your own firm to produce that work, and you make a profit for that work. And part of your compensation should be for the fair value of your services that you provide, and you should pay payroll tax on that. And part of it should be considered profit, not subject to self-employment tax. If Sally Associate is performing work for you and she profits, then those profit distributions should also not be considered subject to self-employment tax. So you need to be very careful, and you need to think about the hats that you wear in your firm and what types of things you do in your firm. So the IRS looks for the following things. They look for personal services. They look for who those services are performed by in the course of the business. So for example, if you take 100% profit distribution, the IRS is going to look and see if you performed any services in the business. If you did, you're not entitled to that. They're going to look to the extent that gross receipts are tied to services. So how much of the business profit is tied to your services? And you may be sitting and saying, I'm the only person in my law firm, every dollar of profit, every dollar that comes into my firm is tied to my services. Well, it's true, but how much of it is tied to your services as the associate? How much is tied to your services as the marketer? How much is tied to it as for your services as the administrator, the person who prepares the bills and sends them out and goes and collects the money? So gross receipts may be tied to one person's services, but there are a multitude of services. And when you are looking at somebody who wears multiple hats in the business, you may have to compensate them, or at least come up with a definition of reasonable compensation within those tiers. If the IRS doesn't agree with how you have come up with your own personal definition of compensation, then they may reclassify it. They may either shift it towards wages, resulting in you paying more employment tax, or they may shift it towards profit. What happens in C corporations is C corporations, because of the double taxation, are naturally inclined to try and zero themselves out by distributing salary to their owners. In the case of a C corporation, the IRS will come back, will look at taxable wages, and will say those wages are not, that compensation is not reasonable for the services that are being performed, and will do the inverse of what they do with an S corporation, which is allocate towards profit, and therefore that's not deductible to the corporation. So the IRS will come in, and depending on the circumstance, will make different classification adjustments based on that. But you do need to be aware of. So the IRS will also look at other factors. They'll look at the services of non-shareholder employees. They'll look at the revenue that's being generated off of any capital or equipment. They'll look into other factors that might tie into gross receipts other than the service being performed. So, if you get a lucky break, if you have a great month with respect to marketing, other things that would tie in other than the associate doing the work and billing the hours. From a reasonable compensation standpoint, they'll look at the consistency of the compensation. So is your compensation fluctuating by how much money you make? They'll look at the company's overall financial performance. They'll look at the increase in marketing, advertising, or rainmaking functions. Although I haven't had too many auditors look at those because, again, auditors really don't understand. Most auditors don't understand how to run business. And they'll look at statistical data to try and find a benchmark. They'll look at salary.com. They'll look at risk management. They'll look at things like that. They will, so the way this functions on an IRS practical basis is they're trying to determine a split between business goodwill and then the outside direct, the production of income related to direct services performed. So how much of the recurring revenue is based on the inherent goodwill that you have built up as a practitioner practicing in this area of law for a number of years, and how much of that revenue is tied to direct services. So businesses that are very new don't have any goodwill or have very little goodwill. Businesses that are more older and established will have a substantial amount of goodwill. So the question becomes, if you were no longer with your business, would there be income still generated? And from a reasonable compensation standpoint, it is important. So let's just do a quick example. The law firm makes $300,000 in 1 year, and there's $100,000 in net profit at the end of the year. How much of that should we consider as wages, and how much of that should we consider as profit? So how much of that is subject to an additional 15% in self-employment tax or in Medicare and Social Security tax, and how much of that is not? So we have to look at a number of factors. So what's the business's marketing activities? What is the work that the owner operator has been doing to generate revenue for their business? Have they been doing a substantial amount of marketing activities? How do they spend their time? Is this a business where we have maybe multiple employees generating revenue? Do we have only one employee generating revenue? How much would this person be earning if they did not work at their law firm? If they were hired as an associate in a comparable firm, in a comparable position, would they be making the same amount of money? The answer to that question is no, they shouldn't be making the same amount of money, because they're up to a certain point, you should be getting compensated as the owner of your law firm. So within that, we can look at maybe taking $60,000 as reasonable compensation and $40,000 in profit. You might want to feel comfortable taking $70,000 as compensation for services and $30,000 in profit. You may want to say that you only earn $40,000 and take 60,000 as profit. And really what this relates to is it's a combination of these factors. But on an audit level, if you can sit down across from the auditor and explain to them with a straight face on why you chose the position that you did, more than likely they're not going to challenge it. So as long as your position is reasonable and you can articulate it based on these factors, they're going to believe your position with respect to reasonable compensation. For businesses that earn higher amounts of revenue, although there is an additional tax once you reach a certain income threshold for Medicare and Social Security, generally speaking, as long as you were at the FICA cap, that will be considered reasonable compensation. I haven't seen too many audits where an owner who sets their salary at the FICA cap, means they max out their contributions to Medicare and Social Security, gets audited additionally on a reasonable compensation level for how they allocated salaries versus profits. It just necessarily doesn't work that way. And the reason for that is, as you continue to earn more money in your business and take out more as wages, your contributions to Medicare and Social Security really aren't going to increase that much. So it's not a huge factor for the IRS. So now let's talk about maximizing deductions and minimizing taxable income. Couple of different strategies. Number one, you can incur expenses that you would have to incur in the next year by purchasing in the previous year. So stocking up on office supplies, paying upcoming registrations for January when bar renewals are due. Really figuring out what your net profit is and sinking more of that net profit into expenses. You may incur less expenses in the next year because you prepaid them in the previous year, but you're going to pay less in tax this year and are going to gain a benefit from being able to defer your tax liability. Credit cards are a really great way to do this. If you can charge a whole bunch of things on the credit card, assuming that you pay it off relatively quickly and don't get hit with the additional interest expense, that's a very good strategy. Deferring income into the following year. So there is specific language in the attorney audit technique guide that they look for this. But really, from a practical standpoint, if you don't issue billing until the end of the month and your client doesn't pay you until January, there's not really a whole lot you can do about that. Retirement plans are a topic that we could dive into in great detail and probably are outside the scope of this. But if you utilize a SEP IRA, there is a deductible portion that you can use to offset taxable wages. And then the other most common one we see is purchasing qualifying equipment and utilizing a Section 179 deduction. So computers, major office equipment, things like that will all qualify for a Section 179 deduction. I want to talk to you briefly also about audit issues for attorneys. So attorneys are hot candidates for audits because there is the propensity for attorneys to tend to cheat on their taxes. Not saying all attorneys do, but because attorneys understand where the line is, they tend to be a little more, we'll call it flippant with the line. When you get audited as an attorney, it is very, very emotional for a lot of people, unless you deal with the IRS every day like I do and interact with them. You will have a sense of anger. You may be confused. It's a frustrating process. The auditors generally, if we had to make a list of professions that the IRS doesn't like, accountants number one, attorneys number two, because if there are things that are gray, they feel like you potentially should have known better. And there's a huge consequence for that. Audits are time consuming. They're expensive from the business standpoint because whether they require funds to go out and hire somebody like us, or it requires the substantial time away from your business to prep and give documents to an auditor to substantiate the audit. Audits can be very, very time consuming, even with very good business records. So those are the main drawbacks in audits. How people are selected for audit. So let's say we're in San Diego and there are 100 attorneys who file tax returns. The IRS is going to score those tax returns based on where those attorneys live and a variety of other statistical factors: how much money they made, how much in deductions they took, how much profit they made, what their markup percentage is, a whole bunch of numbers. And then based on ratios, which the IRS doesn't publish, but people like me kind of understand, they will come up with a statistical graph. And just think of it like a big line graph, but with multiple data points all over the line graph. And they will tend to audit the people at the bottom of the graph and the top of the graph, because those people are the people that are most likely to have inaccuracies on their return. They do a separate scoring for unreported income. It doesn't really fall too much with attorneys unless you are a contingency lawyer or a criminal defense attorney. Criminal defense attorneys tend to deal with high amounts of cash on occasion. Contingency lawyers tend to have issues with their trust accounts and things like that. So one of the biggest audit issues for attorneys is with IOLTAs. So they are deposits that go into IOLTA and that are not transferred into operating are not considered income. Expenses paid out of the IOLTA account directly are non-deductible. If I go to court and the court charges me $100 in a court cost and I write that check out of my trust account, that is not deductible. IOLTA, client's money, separate funds, the accounting that comes out of that is not deductible from an attorney perspective. to the extent money comes into the operating account, and to the extent you recognize revenue on that income, you can deduct the corresponding client cost, but you cannot double dip. Again, here are our ordinary and necessary business expenses. These are really where the focus is for attorneys in audits. So for example, meals and entertainment, in order to be deductible, they either have to be directly related to a business purpose, or they have to be associated with the business conduct of the owner. So those seem to be kind of the same thing, which they sort of are, but also are not. So really what they're doing is, on a meals and entertainment basis, when they go through this on an audit perspective, they're going to say, you went and ate Chili's last night and you spent $7 on a hamburger. What was the business purpose of you going out to Chili's and spending that $7 on a hamburger? Were you eating by yourself? Were you eating with other people? Were you eating with your family? That's where they really pick apart meals and entertainment. Entertainment expenses, on an extreme side, trips to Vegas, although we've had success in our firm having trips to Vegas written off depending on the conduct of the individual who's conducting the trip and the business purpose of that conduct. But, you know, things that look like they are fun. If it looks like fun and it is a business, to the extent it looks like fun and it is a business expense, the IRS is naturally going to be skeptical. Doesn't mean that issue is not going to fly during an audit. It just means that they're going to be skeptical. So because this is a presentation for attorneys, we can't get through this without a case citation. So let's talk about Israelson versus the United States. So attorney throws a party at a country club. There's some clients there, but no business was discussed. No business is allowed. You take a client to a baseball game. You don't talk about business. No deductions allowed. You do talk about business. Deductions allowed, to the extent that that expense is not exceedingly personal. Audit issues for attorneys. Travel expenses for family members are non-deductible. You're never going to convince the IRS. Otherwise, the only limited exception is if you have a spouse and there is a clear reason for them to go on the trip. Personal expenses devoted to bringing young children. This is the only other exception. If you have an infant child or if you have a very young child and you and your spouse are both part of the business and it is essential that both of you go on the trip, the child's portion of their travel cost is deductible. Not their meals and entertainment, just the travel cost is deductible. Travel expenses for the business owner, if they are business related, are tax deductible. What to keep when you're traveling? You can substantiate travel expenses through hotel receipts, hotel transportation receipts. We generally generally do a deduction for tips. So, you know, if you like to tip in cash, it's not always possible to get a receipt for that. So we'll have a general tip fund. If the tip fund is small enough, if it's not like $500, if it's like $50 or $100 for a trip, then that's okay. We do that as petty cash. I've had that survive audit issues with certain people. Auto expenses. So you, as I said earlier, you really want to break out the percentage allocation between what is business and what is personal. Again, the IRS is really not going to challenge you on the allocation so long as it is reasonable. Where it's not reasonable is if you're writing all of your gas receipts off through the business and not deducting a personal component. You have to, no car, well, I won't say no car, but almost no vehicle, if you have a single vehicle, is used entirely 100% for business. If you're in New York City and you walk or take the subway everywhere and you have a car and it's only for traveling for client trips and things like that, and you decide you don't want to use the train, that car is 100% deductible. That's probably the only limited example that I could think about. Attorneys, several that I have represented, have disguised hobbies within their business. Luxury travel is one, wine collections, car collections, really excessive personal travel that's written off for the business. We've had situations with people who are plane enthusiasts. We've had airplanes try to be written off through the business. Airplanes in general are red flags for the IRS, but a lot of people will, throw wine tasting dinners, or, will say that they're buying classic cars as a means to impress clients. And again, to the extent those expenses look more personal in nature than business, that's where you're really going to get tagged. Advanced client costs. So the costs that are paid on behalf of things that are for the client are not deductible because they're considered loans. So if you're advancing client costs and you are eventually reimbursed for those client costs, you cannot deduct that in the year in question. So for contingency attorneys especially, this can be potentially problematic. If you go out and spend $25,000 on an expert witness or an expert to testify in your case, and the client is expected to reimburse you out of the settlement, you cannot write off the cost of that person in the year in question. So that's kind of a negative thing. You can, however, treat income in that year in question. So contingency attorneys have a lot of issues, most of them related to timing with the preparation of their returns. But it's one thing to be considered. Other things as well, other practice areas as well have these issues, but contingency attorneys are, in particular, ones where we see advanced claims. And then just general rules for audits for attorneys. Anything that looks like are clearly a personal expenses that's being paid out of the business is going to be treated as a dividend. So if you have a habit of commingling expenses, don't do that. It's better from your standpoint if you keep personal expenses and business expenses separate. It will really help you in an audit if you could say, here are my personal expenses, here are my business expenses, and there's not a lot of overlap, because it will lend more credibility to the business expenses being truly business expenses. So I would establish separate personal and operating accounts and not combine the two for smaller law firms. With bigger law firms, I would almost advocate that you maintain two business accounts, one for expenses that are definitely ordinary and necessary, and one for expenses that are kind of, we'll call them quasi-questionable. If you do that, then number one, you're going to be able to have really clear accounting. Number two, you're not going to run into, you probably won't run into too many issues in an audit by separating out those expenses. The auditor is going to go through the second account, but at the same point, you will lend more legitimacy if you can come up with a motivation for separating out those expenses. So if you have a client cost bank account, or if you have a marketing bank account, marketing bank accounts are great, particularly if they're funded with revenue, with a percentage of revenue, and you don't just put money in there randomly. But there's a lot of things that you can do to kind of structure things so that they look good from an auditor's standpoint. Again, the auditor is just looking for reasonableness. If it looks reasonable and it really is reasonable, they're not really going to challenge it. Reasonable compensation, like I said, if you can articulate to the auditor a clear purpose in the split between your payment for services versus payments from the corporation, you're fine. The owner does have to be on payroll. If you're a sole prop, you don't have to be on payroll. If you're a corporation, you absolutely need to be on payroll. As we had mentioned, there are income issues. So deferral of income is one, although I haven't really seen that too much except with contingency attorneys. Billing issues, bartering. If your client sends you if you forgive a bill and the client sends you a case of wine, you're supposed to pay tax on that. Cash payments. Cash payments are really frequently being targeted by the IRS, so criminal defense attorneys are much higher risk for audit than other types of practices. And that's pretty much it. So here's my contact information. If you have any specific things that you want to ask me, you want to set a consultation, you're more than welcome to contact me directly. But anyway, I hope this was fairly helpful, and now we can turn it over for questions.
Great. So our first question is, can you take a deduction for work that is done but not eventually paid by the client, where the client just doesn't ever pay you?
Can you take a deduction for work that was performed? Essentially, the question is, can you take a deduction for bad debt? The answer to that is no, because you're not recognizing that work performed in revenue. So if you want to do, so let's say I performed $20,000 in work for a client and he only pays me 10. It would be reasonable to take off the other $10,000 in work only if I were going to recognize that $20,000 is income. The whole $20,000 is income, which I don't know why you would do that from a tax perspective, and it's not the proper treatment because you never actually receive that income.
Thank you, Sam. The next question is about the working meal plans. Could you elaborate and provide a little bit more detail in regards to how it works for a home office operation? Is there a certain amount of hours required or any kind of formal documentation that you need to have on file in case of audit? And what if you eat outside? You spent all day at your home office and you want to go out for a nice quick meal outside. What are the issues with that, if any?
So from an audit perspective, number one, you should definitely have a formal written policy. If you're running a business, even if it's just you in the business and you're working out of a home office, you should write a policy as if you had 10 employees under you and say, what is the policy I would want to have in place for all of my employees? What the actual policy is I won't say it's not exactly as important. You're the owner of the business. You can set whatever policy you want, provided it is non-discriminatory. So it has to be equally. You can't say that if the secretary stays past 7, she doesn't get to eat, and you as the owner or you as the senior attorney or something like that. So the policy, if not discriminatory on its face, is okay. From a home office standpoint, you also have to pretend that you're not working in a home office. If you had an outside office and you set the policy, it has to be in terms of reimbursement, or it has to be in terms of the firm will pick up the cost or something to that effect. You can't take like $25 and go out and buy groceries. So you can't say, I have $100 in grocery this week. I'm just going to work past 7 every night and get my grocery bill paid for. That's something that's probably not going to fly in an IRS audit. It's probably better actually if you go out and have a meal in a restaurant, because that more promotes the policy considerations behind a working meal. You're tired. It's the end of the day. You've had to put in work that is beyond the normal course, and therefore you are entitled to deductions. Again, if you abuse the policy and do this 5 nights a week, you're going to get looked at in an audit. But to the extent that it's twice a week or it's only sporadic, you're probably going to be okay with that. Like I said, it looks reasonable. It is reasonable.
Sam, the next question is in regards to choice of entity, specifically in Colorado. What is the best entity you recommend to find a good middle ground where you can both lower your federal tax and contributions to Social Security, yet have enough, contribute enough so that when you retire, you could get $2,000 a month in Social Security benefits? Is there a middle ground? I mean, especially if you're like 20 years away from retirement, what's your recommendation?
So first of all, I'm not a Colorado attorney, so I can't speak to anything state specifically in Colorado. But this is the balance that you're going to have to come up with when you sit down with somebody and form a retirement plan, because you are going to get taxed on wages, and you can take a deduction. Usually with a set plan, it's up to 25% of the wages, was subject to a certain cap, but you're also going to have to pay tax on the remaining wages. So it's more of a balancing act. My personal thoughts about Social Security aside, I think from an investment standpoint, and again, I'm not a financial advisor, but you would be better off taking the profits from your law firm and paying tax on them and finding another avenue to reinvest them versus worrying about writing them off on your return. And or if you have a 20-year lead time, you should take the profits and invest them in your business and grow the business, and then that business will generate more in profit for you.
Great. And the third question is, if you do pro bono work, can you deduct those hours?
No, again, in line with the what do we do about bad debt, if you do pro bono work, you cannot, there's no revenue associated with that. Therefore, there's not a corresponding deduction. You cannot take a deduction for the quote unquote value of your time. So if for example, I participate in the Leukemia and Lymphoma Society. I contribute and give money every year. I can't say that I'm going to donate 10 hours of legal services to Leukemia and Lymphoma Society and then take a corresponding deduction for that. The IRS just won't let it fly.
Okay, Sam, we have one more question, and in regards to cell phone use, if you have one phone that you use for both personal and business, what's the best way to kind of organize it so that you can deduct your business use for your taxes?
So the way I did it when I was an IKEA desk and a cell phone, to give a personal example, is I would pay for the cell phone 100% out of the business, and then I would take only a deduction with respect to what I considered the business use portion of it. Now, back in the old days when it was me, an IKEA desk, and a cell phone, I was in like hustle, market, sell, because I didn't really have any clients. And the only time I really used my cell phone was less to talk with my friends who, I didn't see a whole lot, and more to conduct business activities, or because I didn't have a main office phone or things like that. So in those situations, I felt pretty comfortable taking a very high cell phone allocation. And I would think, as long as you think that is reasonable to your particular usage of cell phone, you could take a fairly high allocation for that. If you get 20 calls in the day and 18 of them are business related, take an appropriate allocation for that. There's no problem taking a 90% deduction for your cell phone, so long as it's reasonable. What's the auditor going to do? The auditor is going to go through your phone bill and, make you go through and say which calls are business and which calls are personal. I doubt it. So again, you can be reasonable in that. If it's your primary line, I would feel comfortable taking a very high deduction. I would shy away from taking a 100% deduction unless you really don't talk on the phone for personally, and you could reasonably classify your personal use of the phone as just de minimis.
Sam, there's one more. I apologize. There's one more question that came on. And where would you recommend for attorneys looking to find more detail about tax laws? Are there websites or periodicals that you recommend for them to read on their own?
It depends on what you want to learn about.
Well, as it relates to solo practices and small law firms and tax preparation for their own businesses.
There's a number of resource materials that are out there for maximizing small business tax deductions. I would shy away from law firms because law firms are very specific. I haven't seen a whole lot of content specifically on how law firms maximize their tax breaks. I know that there are some management consulting programs that are out there for lawyers, like I know How to Manage a Small Law Firm is one that offers tax-related workshops. From a resource perspective, as long as you're looking at this from a small business owner perspective, there are usually some pretty good books out there. As far as educating yourself goes, you can try and read and get a general knowledge of this. That would be very, very helpful for you. But the most important thing you can do is have a very, very good and knowledgeable CPA and or somebody like me in your back pocket. The reason you would only need someone like me if you got into trouble or from, you're trying to plan this out from a planning standpoint and you want my advocacy related take on this versus a compliance perspective. There are CPAs out there, although few and far between that I've met, that are more advocacy focused, that are not afraid to take a position on a tax return rather than just look at the tax return as being reported from a compliance perspective. I would speak with a tax attorney. I would speak to somebody and get a recommendation on CPAs. It's important that you have a public accountant that is appropriate to your level of risk tolerance and is somebody you match with from a personality standpoint. Honestly, the best investment you can make is going into that person's office twice a year, having them look at your tax situation and trying to have an intelligent conversation. You can self-educate by going to third-party resources, but the best method of education is by referring to a specialist. If I wanted to know more about bankruptcy, I can certainly read the bankruptcy code, but I just go ahead and ask my friend AJ down the street and say, hey, AJ, tell me everything you know about X. And he would be able to tell me a lot more of it and in a lot better detail because he has working knowledge on the subject. It's hard to get that from a book.
Well, Sam, thank you so much for your time today, and thank you everyone for joining us, and have a wonderful weekend. Thank you so much.